Meet Fannie Mae and Freddie Mac, two mortgage giants that quietly shape the price of nearly every American home loan. Today, they're under siege from soaring interest rates. If you're wondering why buying a house feels impossible, or why the housing market feels frozen, stay tuned. This isn't just about central banking. It's about the plumbing of the entire mortgage system and how stress here could ripple across the economy. Welcome to FluxFolio Finance. Today, we're pulling back the curtain on how these institutions work, why they matter, and how high Fed rates could break the mortgage market itself. Let's start at the beginning. Fannie Mae was created in 1938 as part of the New Deal. Back then, the housing market had collapsed. Banks weren't lending. Fannie Mae was the government's answer. Buy up mortgages so lenders had cash to keep writing new loans. It worked. In 1970, Freddie Mac was launched to keep Fannie from being the only game in town, introducing competition in the secondary mortgage market. So what do they actually do? They don't lend you money directly. Instead, they buy mortgages from banks and credit unions that meet their standards, so-called conforming loans. Then they bundle these loans into mortgage-backed securities, or MBS. Investors buy these securities. In return, they get steady payments of principal and interest. Critically, Fannie and Freddie guarantee these payments, even if the underlying homeowners default. This guarantee makes their MBS safer, cheaper to finance. They're different from Ginnie Mae, which only backs government-insured loans like FHA or VA, and has an explicit U.S. government guarantee. Fannie and Freddie have an implicit guarantee, and they're massive. As of 2025, Fannie Mae has around $4.3 trillion in assets. Freddie Mac isn't far behind. Together, they underpin roughly 70% of America's home loan market. They make mortgages cheaper, more liquid, and easier to get. But that comes with risks, especially when rates go haywire. Here's how the MBS ecosystem works. Your local bank writes you a mortgage, but instead of holding on to that 30-year loan, they sell it to Fannie or Freddie. This gives the bank cash to make more loans. Fannie and Freddie then bundle these thousands of mortgages into giant pools. These are securitized as agency MBS, essentially bonds backed by streams of mortgage payments. Investors love these securities. They're relatively safe, pay predictable income, and carry that all-important Fannie or Freddie guarantee. But not all MBS are equal. Agency MBS have that government-sponsored backing. Non-agency MBS, private label deals, don't. They carry higher risk and often pay higher yields. Then, there's Ginnie Mae securities, which have an explicit U.S. government guarantee because they're built on FHA or VA loans. Investors assess these MBS based on yields, prepayment risk, homeowners refinancing when rates fall, and default probabilities. And when the Fed steps in, buying MBS in QE or selling them in QT, it can dramatically change how attractive these securities are. This entire system is why your personal mortgage rate is linked to global capital markets, bond investors, and central bank policy. Now let's connect the dots between Fed policy and your mortgage rate. The Fed sets the federal funds rate, which is the overnight rate banks charge each other. This anchors short-term interest rates. But your mortgage is a long-term commitment. Enter the 10-year Treasury yield. It's the market's best guess of what short-term rates will average over a decade. When investors think the Fed will keep rates high, the 10-year yield rises. When they expect cuts, it falls. Your mortgage rate is often modeled as mortgage rate or 10-year Treasury yield plus MBS spread. The spread compensates investors for risks like prepayments and credit losses. So what happens when the Fed does quantitative easing? They buy MBS, demand rises, prices go up, yields and mortgage rates fall. QE narrows the MBS spread, making home loans cheaper. But now we're in quantitative tightening. The Fed isn't buying. In fact, they're letting MBS roll off their balance sheet. Demand drops. Investors want more yield to buy the risk. Spreads widen. Mortgage rates climb. This isn't just about Powell's policy rate. It's about the entire term structure of interest rates and the Fed's direct presence in the MBS market. The result? When the Fed holds rates high and sells MBS, mortgage rates soar, even faster than Treasury yields alone would suggest. So what does all this mean for Fannie Mae and Freddie Mac? First, loan origination is slowing. High mortgage rates deter buyers. Fewer people want to borrow. That means banks originate fewer loans to sell to Fannie and Freddie. Second, their fee revenue drops. They make money by guaranteeing payments on MBS. Less volume equals less revenue. Third, they're exposed to market value risk. Fannie and Freddie don't just securitize loans, they hold portfolios of mortgages and MBS themselves. When rates rise, those assets lose market value. And there's a fourth risk, their ongoing conservatorship. Since 2008, they've been under government control via the FHFA. They've returned to profitability, but they're still vulnerable to policy changes. Should they be privatized? Should the government keep backstopping them? In a high-rate environment, these questions get sharper. High rates squeeze their revenue, increase guarantee costs if defaults rise, and pressure their retained portfolio values. Meanwhile, political battles brew over what to do with these giants. If they struggle, the housing market's liquidity lifeline is at risk. Because when Fannie and Freddie can't buy loans from banks at scale, the whole mortgage origination system slows down, raising costs and reducing availability for buyers across America. Now let's talk about the vicious cycle. Mortgage rates today average around 6.7% to 6.8%. That's more than double pandemic lows. Affordability has cratered. Buyers are priced out. Home sales volume is at its lowest point since the 2009 crisis. Meanwhile, existing homeowners are locked in. They refinanced at 3% rates. Why would they sell, move, and take on a mortgage at nearly 7%? This lock-in effect freezes inventory. Fewer home sales mean fewer new loans for lenders to originate. That means less business for Fannie and Freddie. Investors see the slowdown and demand higher yields to hold MBS. Those yields push mortgage rates even higher. It's a feedback loop. High rates reduce affordability. Sales drop. Fewer loans get made. Fannie and Freddie securitize less. MBS demand wanes. And spreads stay wide. Rates stay elevated. It's not just an economic model, it's real pain for anyone trying to buy, sell, or refinance a home. The Federal Reserve's balance sheet is a critical piece of this puzzle. When the Fed does quantitative easing, it buys MBS in huge quantities. This drives prices up and yields down, compressing the spread over treasuries. Mortgage rates fall. QE was a massive driver of sub-3% mortgage rates during the pandemic. But now we're in quantitative tightening. The Fed is letting MBS holdings run off. Private investors have to step in, but they want higher yields to absorb that supply. Spreads widen. Mortgage rates rise. Research shows the Fed's MBS holdings have a substantial effect on keeping spreads tight. Without their buying power, the market demands more compensation for risk. So as long as the Fed remains in QT mode, mortgage rates will stay elevated, even if Treasury yields alone stabilize. The stakes aren't just financial, they're political. There's a renewed push to privatize Fannie and Freddie. Some see their conservatorship as a permanent distortion. But others warn, removing their implicit government backstop could raise mortgage costs by $700 to $1,600 per year for borrowers. Meanwhile, the FHFA itself is in turmoil. Bill Pult, the new FHFA director, made headlines by urging Fed Chair Jerome Powell to resign over high rates, accusing him of crushing the housing market. It's a battle over who controls credit and who pays the price when policy changes. Privatization could shift risk to borrowers. Federal backstops keep rates lower but put taxpayers on the hook. And all of this is happening while rates are at 20-year highs, the housing market is freezing, and affordability is cratering. It's not an academic debate, it's your mortgage payment on the line. Fannie Mae and Freddie Mac are the hidden engines of the U.S. mortgage market. They keep loans flowing, they spread risk. But high Fed rates are shaking that entire system. Fewer loans, higher costs, wider spreads, political fights over who pays. It all affects whether you can buy a home, how much it costs, and what you'll pay every month for decades. If you want to understand your own finances and the future of the housing market, this is a story you can't ignore. Thanks for watching FluxFolio Finance. Like and subscribe for more deep dives on the mortgage market, the Fed, and the forces shaping your wallet. Let's decode the economy together. See you next time.